Go ahead and get started. A very special guest for our meetup this month. We have Sam Sharp, who's here to share with us his expertise in the lending world. He has over 20 years of experience in the lending world and is currently the Executive Vice President of Guaranteed Rate. He was a speaker over at the Midwest Real Estate Networking Summit this past summer, and he's been in the industry for quite some time and has lots of really good nuggets to share with us today. So everybody give it up here for Sam Sharp.
Here, I guess just right here. Good afternoon.
Good afternoon.
Good. So interestingly enough, I had prepared a little bit for this, and to prepare, I went back and reread a little bio clip that I gave you to promote this. Like, well, what am I talking about? What did I say I was going to talk about? And so I went and prepared some things about that. And the mechanics of it was initially talking about buying a home that would be geared towards first-time home buyers now. And I thought for 2 minutes, probably just took myself out of that. I would realize that we don't really have any first-time home buyers here. Anyone?
First time.
Yeah, you look
First time?
Right, actually. Sorry.
Yeah, no.
First time. So because of that, I think I'm gonna pull an audible in that case. I don't know how much you want to hear about what I was going to say about that. I don't think it's relevant. So that'll take us to a little bit further along through. So Sam Sharp, Executive Vice President at Guaranteed Rate, local lender, national lender, but born and raised here in Chicago as far as the company goes. The state that I've been in the lending industry for 22 years. And well, I guess some relevance towards the initial story I was going to tell. So 2004, I've been in the industry for 3 years or so, and I decided I wanted to buy a home. And buy my own place. Now, it wasn't because of the clever rent versus own schedule that I had created for marketing purposes. It wasn't because all the things that I put out there to tell people why you should buy a home, it really had nothing to do with that. I just wanted to be living in a new place. I grew up in Colorado, very poor, I guess we'll say. That's putting it lightly. And I just at this point in my time, I was in my career, I was doing well, and I was like, I want something. I want it, and I found it too. I found a really cool duplex up condo in the Ukrainian village. Bought it in 2004, and I sold it. I closed on the sale of that in December of 2005. At the time, it's like I closed on selling my condo in 2005. I closed on buying my single family home, which was next to the trail over here in 2006. I don't know how they were thinking about where I'm going with this, but it's a different world, right? I moved out in 2006, things took a drastic turn. I actually remember when I was selling my condo, I remember just looking at it, and I'm in the Ukrainian village, and all of a sudden I started seeing properties pop up because, of course, I did not turn on the search engine agent with an agent there. They had the search engine set up to sell me property. Even though I know better, I still kept looking. I just kept looking. I saw this place that was amazing. It looked like my place is a duplex. I think it was actually in River Park. In 2005, River Park was the Ukrainian village. It's a different world. That was better real estate. And it was on the market for about $30,000 cheaper than my house. And I thought that, and it's just like, oh my God, please close. Because, we're trying to see the writing on the wall. The market's crashing. So, and it closed. And then I bought my single family home over here at Oakland Square. Now, I got lucky, right? That wasn't on purpose, and it's so funny because it's not that I was made yesterday, but it's a saying that I heard earlier that when history is being made, don't realize that you don't understand what's happening. Hindsight is 2020, insert whatever type of neat saying that makes you feel good about sayings to make me feel good. And I got very lucky because I did look to buy a home because I wanted a place. I found a place that I wanted to live, and I also got very lucky because I sold it very quickly for a lot more than it did when the market crashed. And I've always been able to stay out in front of things now because I was thinking, as you've been first-time home buyers, I would segue from this point to tell you about how to prepare for buying a home, things to think about. But I will say that it has some relevance towards my personal involvement and understanding as an investor. And for that, how I came into that, it's like going several multi-units, 27 doors. And it was my retirement when I looked at. And it's one of those things where you kind of stick, you kind of go with what you know, right? And for me, it was a matter of, in hindsight, looking at how mistakes could actually lead to something and how there's something good behind things that think are just terrible. So I thought I was really smart when Sirius XM, when they were going to merge, right? XM radio, and that's like, one satellite radio position by trade. So once upon a time, more things they always do is to the country and music. That's how I did. And so I'm like, oh, this is gonna be big. This is gonna be big. I'm gonna buy some stock. I'm gonna get a trader. I've got some money in my pocket. I need to invest. Right? What am I gonna invest? Buy some stock. I bought Sirius XM, and it was so funny because I'm like, all right, and I spent $2,000 in the stock. $2,000 I had to get it. There's a lot of money. Okay, this is a big deal. I've never done anything like this before, but I'm gonna give this a go. But I do know one thing, like again, this Clutter saying, right? It's not timing the market, it's time in the market. So I just set it, forget it, put it in the E-Trade account. So I bought this stuff. It's E-Trade. So what I didn't realize, though, while I'm not paying attention, so I'm busy trying to figure out how to do mortgages and how to buy property and do things and help people in this wonderful world. Meanwhile, that stock just tanked. I mean, it got down to like 2 cents a share. What was that? And it got down so low that E-Trade actually liquidated my stock and sold it because I owed them money. So I got a statement one time. The first time I ever did anything from them ever. I never reached out to them, I never find anything, I never hear anything until all of a sudden I owe them money. I owe them money, but like $2,000. Actually, sorry, I bought $1,600 worth of stock and I left $400 in the account. And they ended up selling my stock after they drained the $400 to maintain the account. Like, oh wow. Set it, forget it, and that will didn't work. And so I thought, wow. Investing sucks. I suck at this. I'm just gonna keep doing more because I'm good at this. I'm making good money. I don't know how to make sense about it. Well, fortunately, from there, I started to realize that wasn't a good theory, and I was like, all right, stick with what you know. What do you know? Real estate. I know these up and coming areas. Being a drummer, right? So I bought my house here in Logan Square now because I thought Logan Square was going to be the up and coming hot neighborhood. Right? Although that was part of it, that was definitely underneath there. I bought it because that's the only place I could get a single family home. I bought a really nice house, brand new construction. Only place I could afford to buy a really nice house. Again, this is 2006. Logan Square looked a lot different. This is not here. And it was interesting, you go through that, and you try to stay out in front of things. I started thinking about, all right, well, I'm pretty good at figuring out these places. We were just talking about this. And I started looking out there, and I think a lot of you probably know Bree Schmidt, right? Started to be Bree. We used to butt heads about my investment strategy about buying multi, and so when I thought, like, that's not a good buy. Why would you buy that? That's fine. And I had a different strategy. See, my problem was that I was cash heavy. I was saving a bunch of money from working. I wasn't spending it, and I was in a position where I was like, all right, well, I got to invest my money. So the supportive partner was kind of cool. It's 2009, right? On my first 2-flat with a garden apartment, and it's $265,000 for that property. And renovated units at $8,000 first place. Because when I started looking into it, I was like, okay, so people are paying $1,200 in rent. And these two, $1,200, and $750 in the garden apartment. They're still there, so actually, the tenants in the garden apartment are still there.
Wow.
And it's so funny because I'm thinking, okay, so under $300,000 for this, and they're paying that amount of rent. Meanwhile, in Work Park, I'm going to pay $550,000 for the same property. That sounds, well, wow, really good that too. But the rents were the same. So I did the math. I'm like, okay, I'm going to leverage my cash. I'm going to buy in large down payments. I buy my properties. I put 30% down, and I put them on 15-year notes. Now that's where me and Bree started to disagree. It's like, well, why were you're leveraging your cash too much? My argument was like too cash heavy. Like if I keep my cash, I'm going to buy some stock like an idiot, get all my money. You understand? I don't know what to do with this. I want to park my money. But for me, I was, well, I'm going to put this money down, and my properties are breaking even. I'm not making money, but I didn't want to make money. Didn't need a property cash flow. I didn't need to see residual income that I could use. I'm like, okay, this works for me. I like this model. I'm just stick with it. That's the term. Talk to you. And going to looking at it now, I've gone on to buy a lot of property since then, following that same model. And the best part about it is like, it's 2023, right? Like, I'm almost free and clear every year. I was buying one a year, every year. The plan was I was going to buy 30 properties, one a year for 30 years, and in 30 years, because when I first started, I did buy it under a 30-year fix. When I first started, I was going to do 30-year fixed mortgage, one a year for 30 years, and then that will be on free and clear. And every year after that one, another one will be on. That's my first time. And then not too long after I bought my next property, and then I refinanced into 15 years and changed it. Like, all right, I'm going to buy 15 in 15 years. I'm going to retire early in this. Of course, you predict the future in this world. So, following through that strategy, though, it worked out really well because now those properties are almost free and clear. I have the mortgage notes. I get the mortgage statements, and I don't know which property it's tied to. I used to make fun of my clients when they try to tie the mortgages to the other properties they own. They do not know which mortgage goes to which property. But it's incredible though, because now the cash flow, right now that's risen. Now it's gone up significantly. Property value. I told you, buy a property in Forest Park, multi-unit for even $300,000. You keep, running to get that. The properties are more than double. That's just amazing at the plan and how that works. Now for me, I went with what I do, and I went with what worked. Now that obviously doesn't fit everyone's model, and unfortunately doesn't fit most people's models. Not most people are sitting around like, what do I do with all this money? It sounds like very, as I say it out loud, it kind of makes me sound bad. It's not the way I mean it. But the reality is when you're looking at that, you have to start to figure out ways. When this was Bree's model, how do you leverage your cash? And I agree with this, right? I can find data and information to support pretty much almost anything, right? Two sides of every coin. It's like you can find enough to support either side of the coin, and they're both right. It's depending on what you're confident in and which one you follow through with, which one is consistent. So you have to identify, as a for all the investors in this room, you're buying properties, you try to think about that. So from there, you start to identify, okay, well, what am I planning to do, and how am I going to finance the properties? How many do I want to buy? What do I want that to look like? How long am I going to hold them? What am I going to do with those properties? In my example, my properties now are not my properties; they're my trust and for my kids, right? For the children. So what we do. I'm like, okay, so this is their retirement money. That's still my retirement plan. The idea now is that these properties later will generate the rental income, which will be the money that our family will live off of. And then when we pass on, they'll have a trust for the kids if they're an appreciating asset. It's not generating revenue. That then goes back into the trust. Because I don't know, I'm still debating if I ever actually give the kids They're 6 and 4, so I got So you start to think about those strategies. Now, going through looking at that, who has more than one property? Who has more than 2 properties? Got more than 5 properties? He's speaking next. When you're going through and you're looking at it, you think it from that first 5+ properties, you're thinking about it in certain situations, you have to start to think about how you're going to get where you want to be. How can you get the most bang for your buck and leverage your cash? And that's where the financing side becomes very important, right? The house hacking model is obviously, it's a big thing, right? It's a term, it's a buzzword, it's out there, it's not as popular as the term content. Everyone's talking about house hacking. And the idea now is to figure out, okay, well, how do we purchase properties with little to no money? How can we then continue to watch it over and over again? There was a time frame where we used conventional financing, that led to FHA financing, that led back to conventional financing, and then programs change. Unfortunately, in the lending industry, the only thing that is consistent is that it's constantly changing. And I will tell you that coming up, there's, I'm sure you've seen tons of videos out about Fannie Mae going and allowing 5% down on their multi-units. But I'm super excited about it. It's great. I'm not just excited though because this is going to help my clients and help people who are sitting through going through that model. I'm excited because this is very interesting time, right? The market that we're seeing right now is very different than anything I've seen in 22 years. And it's probably very different than what most people have ever seen. We have shorter inventory, we have higher costs, we have higher interest rates. That's not a lot of that uncertainty for the very strange place. So I get excited because I understand when I see these programs back in 2008 when they were coming out of the crash. That's when Freddie Mac's when possible lifted their income restrictions, right? And what did we have? We had 5% down multi-units. Yeah. Why did that happen? Well, the headlines were because they wanted to help people in underserved areas. But we take a step back. We're going to lift the income restrictions and help people who don't make enough money. That's not what happened. What really was at the heart of that, Freddie Mac needed to lend money. This thing would crash. Fannie Mae and Freddie Mac were like, now they got taken over by the government. The government's business. It's not your. I'm sorry, but I think there are two sides to that coin. And it is a business. And we start thinking about that business is looking for clients and wants to buy. That's actually a really good thing because they're going to do what it takes to make that money attractive, to make it cheaper, to find incentives to get people to find this homes. And that's what we're seeing, right? We're seeing 5% down multi come back into play. Why? Because they want to lend money. And they wants to lend money now, which is great news for everyone sitting in this room. They can start with programs like these and then it becomes more lucrative as they start to realize that there's not enough people to buy this as a primary investment. Now you can start to see some. Maybe we'll start to see some movement on the investment side of that one saying. I don't know. That's still very, very tough. Yeah, but as far as they're concerned, the GSC, which is Fannie Mae and Freddie Mac, saying very clear. There's fortunately those people that are on it. So I think that right now, as we go through and look at buying investment, look at investing in our cash. I mean, is anyone to the point where they've gone through the house hacking or they've bought a multi-unit, they've been living in a multi-unit, but they don't actually want to live in the next one? Yeah. You all have some. Yeah. Obviously, gonna have an opinion pretty soon.
Yes.
Yeah. Well, that's good news though, because if the camera can't see that, but no one makes their hand. It means that you're going to be able to take advantage. You should be able to take advantage of 5% down conventional financing right now because there's no restrictions on that. According to current guidelines, now I will tell you this. We don't know what those guidelines are. I wish I could show and tell you right now this is what this is going to look like. And I don't care what you see on Instagram. There are a lot of lenders out there who are putting things out about this program. I have a lifeline to Fannie Mae. I tell you, I help in my career. I've made big strides helping both Fannie Mae and Freddie Mac rewrite their guidelines. I have a direct contact to how they operate, and I know for a fact that there's not. Can't actually use this program yet. The automated underwriting system that will be required to do this program will not actually run until after November. It will not recognize. Hopefully, here coming up in the next couple of weeks, we'll have some guidelines on what this means. Like if you own too many properties, right? Because that could be very realistic. They may come into play and say, okay, 5% down works unless you have up to 4 financed properties. After that, we won't finance it. That's fictitious. That's not true. That's just something to keep in mind. So keep your eyes out for that because the conventional item and the benefit of this is that it's below value to purchase property, less money down, should be more favorable interest rates, which are that's a subjective term right now. Obviously, money is very expensive. And going through looking at that, I want you to consider your strategy. I want you to think about what are you going to do with that property? How long are you going to keep it? And what do you think is going to happen in the marketplace? So I've been having interesting conversations with my clients over the past few weeks. This is great. So you come to me to borrow money and you say, I've got a contract. and I'm going to buy this property. And let's just say that you're putting 20% down or something to buy a different property. My conversation with you would say, okay, great. I think that you should pay 4 points and buy down your interest rate. You're going to be like, yeah, I'm going to give you $30,000. I'm sorry, that's a terrible idea. I'm going to refinance when rates go down. And you might be right. And I've been believing that myself, right? I have a program called Refi Ready. Every client I close gets immediately enlisted into it. It's basically a tracking system that shows, based off of the average appreciation in the area, their property value, their amortization schedule on their loans, so that I know where they're at all times. And I get software tells me you can lower their payment by $100, give them a call. So I've been using this, I've been actively pushing it. But when you start to look at the coin and you look at both sides, you're taking a bet that interest rates are high and that they will come down. Because why? Because we haven't seen rates this high. But we have. And the last time rates were this high, 1975, the rates went up and they got down to the 8%. They did not go down for 18 years. 18 years. And in that time frame, they spent the majority of it over 10%. And a big portion of it, 13, 15, 18%. These are those stories you hear about. And this isn't that, yeah, the property was $9. It's not that argument. It's good to learn from the past. I mean, I can tell you this. I don't claim to be smarter than the market. I don't really think anyone is. I do like history though. I do like to see how certain patterns can repeat themselves. And when you look at it this way, you're taking a gamble. You're taking a bet either on rates going down or rates going up. When you think of the fact that 75 interest rates were at 8%, that they continue to go up for quite some time, there could be a case made for interest rates going higher than we see right now. I do think they will. I don't think it's outlandish to think that we will see 10% in the not too distant future, and I don't think it's outlandish to think that it may stay there for a while. I hope I'm wrong. It's not a bad problem to be wrong with, but at the same time, it's time to have those conversations. When you're buying that property with 5% down, you're looking at it. You want to hold that in the long term. You want to start to look at what's your break-even point. When you're talking with your lender, and I assume that everyone here has established relationships. When you're having these conversations, and you're talking to someone, what most lenders will do is they'll look at the break-even point. You pay $5,000 up front and you're going to save $100 a month, then it will take you 50 payments, right? So that would be the math. Like, okay, 50 payments under 5 years is great. But what they're missing is the amortization schedule. When you borrow money on a traditional financing, right? We're using a 30-year fix or a 15-year fix, and these models that you're borrowing conventional money. So we're talking about Fannie Mae here, right? When you borrow that, there's a set amount of principal and interest that goes towards every monthly payment. Okay, that is drastically different at a lower interest rate. Just so you know, the amount of interest you pay on a home at 2% versus 4% is not double. Right? When you start to get down to lower percents of interest, the way the interest is calculated, it's not that way. And the difference between 4% and 8% is more. So it's really, when you get into these upper percentages of interest, it's actually drastic on what you're paying. So what happens is in most scenarios right now, if you were to pay 4 points in this scenario and think I'm crazy, your break-even point is usually about 36 payments, 38 payments. Then segueing between the two, because what's happening is that amortization schedule, if you get the rate down to 6.5% versus 8%, your amount of cumulative interest that you paid over that 36 to 38 months is significantly less than the higher interest rate, coupled with the lower monthly payment. So what happens? You break it even after 3 years, and then from there, you're saving tens of thousands of dollars. This does, in fact, go for a decade. This does go for longer than that, and you think yourselves very well. Now, if I'm wrong, and you were my client, and you come back to me in 2 years, and we do the math and say, and then I talk to you and say, let's have that conversation. Like, okay, well, you fell short of covering $4,800. Like, you paid $4,800 in this gamble, and you lost. But what if I'm not right? And that's like, you have to take your risk tolerance. You have to think, what works for you? What works for your investment strategy? Are you going to put $2,000 with E-Trade and then lose it all? Right? I did. It's me. It's how it goes. It's also why I use 15-year notes on my, well, truth be told, I started because I'm a set it, forget it kind of guy. I prefer to focus on one thing and move on, do it, move on. So you have to think about your risk tolerance, what will work for you, but start to think about this as you go through and you start to look at these properties, because a lot of what we're thinking are in our financing strategies up front is we're thinking, okay, the more money I can leverage, I don't want to put too much money into this property because I want to buy another one here. Right? I want to keep going down that path. That's not a bad idea, but make that part of the idea, make that part of the conversation. What do you want to do? How do you want to do it? And how do you want to get there? If you're starting to consider your finances, talk to a professional about what you're going to do to get there. Doesn't matter if it's me or whatever it is you think for. Just talk to them and start having conversations. It's a good, very well put you in a place where you're not going to find yourself wishing you didn't have that stuff. Make sense? Yeah. So, I had that whole first half was going to be about buying a home and all kinds of stuff. Then this half was going to be a little bit about the investment strategy. So, that was a lot of what I had going up there, because I feel like people in the room already know about FHA financing and like more things, because it's been our go-to for the past few years, right? Fannie Mae and Freddie Mac pulled back, FHA will be used to get in. Great. Now conventionals coming back into play. So now we have that. A lot of the portfolio products that we've been using recently that did 5 and 10% down, they were government loans, they weren't conventional. They're not really liquid right now. We've looked into these in the past, but they're pretty much kind of pulled back. They don't like the risk of the environment right now. So this means that you're going to be, if you're all talking about living in your property, the Fannie Mae program is going to be what you're watching. Yeah. How many people in here currently have an FHA loan on the property they live in? How many people have an FHA loan on the property that they don't live there anymore? Yes, you still have that now. You said you were talking back, just the back road earlier, like Louisiana. So you're spread out, not just obviously concentrated in this area. Your FHA loan is in Illinois. Yeah. Okay. So you're going to be tied up with that, right? Well, for those of you who don't have an FHA loan and you have this Fannie Mae program, if we were having the same conversation along these lines, that's what we start to look at, is figuring out we're going to run a cost analysis based on FHA versus conventional. Chances are that you're going to, depending on the guidelines, potentially may take advantage of what you pay out as well and find out what makes sense with that property. But it's good. So the basic principles of stacking those properties and financing them is taking advantage of the properties that do have lower down payments, because they can allow you to use your cash towards improvements on the property. They can use your cash towards, saving. The house that I bought in Logan Square, I always remember, I was so excited. I sold the condo, I bought the house. The day I closed, I had a TV delivered. Amazing too. I was super excited about this. And my drums. That's what this all was in this house. TV and I was waiting for a house, and I went there, and I was gonna use the TV. I hooked up and Blu-ray player. This is 2009. I was. And I was just couldn't wait to see this TV. And I sat down and I couldn't see the damn thing because it was 3 PM and the sun was blaring through this new construction. There was no window treatments. I had no idea how expensive that stuff was, because my condo before that had window treatments. And we didn't even think about it. So maybe you're leveraging your cash because you need to buy window treatments. Maybe you want that TV. I don't know. I'm cool with that. Cool. I like neat things. But the idea is that you're, from a financial standpoint, you're stacking this property, you're using your cash to free that cash up towards either other investments, future properties, maybe paying 4 points when you do buy that property, and starting to get in line with that. But start to consider the options, make a list of what those options look like, make a plan, and then be ready to pivot when that plan changes, because they totally don't help with it. That's kind of all I really prepared to talk about. I'd love to answer some questions. I feel like we've got some pretty smart people in this. So.
Do you have any commercial loan products that you have?
I don't actually know. I think that commercial financing is more than a full-time job, and I also feel that when done right, residential financing is more than a full-time job as well. So I always, in 22 years of doing this, I always stayed away from commercial financing, which is
4 units in this.
4 units of a loan. Yeah.
The Fannie Mae product you talked about, owner occupied product?
It is, yes. That's one thing I know, is that they're not going to go 5% down on that, but I am curious to see what some of the other guidelines, because they're going to look anything, nothing at all.
It does though seem like they moved to what I'm old enough and I remember when the VA loan, you could use it as many times as you want. It wasn't, you used it and then you had to have a pay down, and then you could use the equity that you had in the
Right.
and use up that. It sounds like from the statement you made that this product, this payment is going to be similar in that if you already have a payment, they're not going to do another payment unless that was paid off.
No, I think that if they follow guidelines, so I'll just use a similar product, the home hospital loan, they could utilize this. They volleyed between you could have only one property, and then for a while they changed it, you have to be a first time home buyer. When things got a little bit tough, then they switched, you can own as many properties as you want. Those are the types of guidelines we're watching out for. Right now, I have no reason to believe that they would have a limit on how many properties you have, how they expect to use this loan program. It's not being, at least in its initial presentation, it wasn't based off of underserved areas, income restrictions, none of that has been listed. It's just been, we'll now allow 5% down on multi-unit primary residence. It's about all. That's literally all we know, even though you're going to see, again, you'll see people put stuff up, 5% down this way, oh, a 620 credit score. We have some respected lenders, it's really, it's actually kind of sad to see. Like, why are you, it's the foot pay, why are you doing this? I come to you, I actually called one out in front of me. I said, I want to great, I'm ready, let's do it. Lock me in. And you can block them just great. I'm sure we can do it. Like, really, what are you going to do on the 18th and find out that it doesn't work? You made a commitment to me and I'm under contract and I paid for the footage and I paid for the inspection. Like,
Yank the rug out for them.
yank the rug out of me, and I even talk like, come on, like better than this. Don't do that. They'll sell something you don't have yet, but I think that the program will not have restrictions. I think the biggest hit that's going to be there though is that so low level pricing adjustments, which is what impacts me. How many of you remember? I had to actually consciously figure out when I found my next place and when I found my next place for today. So I mean, fortunately, I haven't crashed. It's like a big reminder. You know, it's like we used the pandemic. Everyone always uses that as a timeline. It's like living by the lake. Like from Colorado, everything's like by the mountain state, everything. Right here, use the lake. And now with the pandemic. So we'll see what I lost my train of thought too.
So I have a question. Historically, how do you see the spread? Like, you know how the mortgage rates are, 30-year mortgages are kind of calculated, or the prices are based on a 10-year treasury plus some spread. That's what usually.
Right.
So now if you see the treasuries are on 4.9, mortgages are 8, about 3% spread,
Right.
3 points. In the past, historically, I'm hearing that it should be around 1.7 spread. Is that true? And why do we see that large spread now, on the 30 years? Plus, I want to understand from you, is selling back, the mortgages to, as securities, is this still going? Are people buying these? So can you elaborate on that?
So it's funny because some of the answers to your question are within your questions.
Okay.
So the reality is that the 10-year is just a general guideline, but it's not the driving factor as far as where that goes. So that spread can change because it's not exactly correlated. It's just been a good baseline used for gauging where interest rates will go. So that's why you're seeing this pattern. There's been times where the treasuries have dropped so far and interest rates wouldn't go down. But we're on the opposite side of this one. It's so low right now. Why are they not low? It's going back to after the crash, actually. So it's not always directly correlated. It is a big driving factor of the mortgage debt securities and where they're selling them. Right. So what's happened and where we're at right now is that there's a massive amount of treasuries that were purchased by the Fed, right? The government goes through, they bought on these treasuries, and that's why interest rates dropped, right? So if you go buy a bunch, then they drop. Right now, no one's buying them, so the interest rates just keep going up and up and up. So they're actively trading them. So now we watch to see the security traders to see what they're doing to try and have a better understanding of where interest rates are going to go. So right now, they're still being purchased, and when you see economic hardships, then that's actually unfortunate. That's why it's better than interest rates, because it's flight to safety, what they call it. Right? People take their money out of the stock market and start buying more tax securities. So, but it's interesting right now. We think for a fact like 42% of the homes in the U.S. are only free and clear. 60-something% of the mortgages that are open are 5% below right now. So mortgage-backed securities are in a very strange position right now, right? Because it'll be, I think the other fact that we'll see, it'll be interesting to see how the non-QM space. So non-QM is the new word for subprime. It's really not subprime. It's not anywhere near that drastic. I'm being very extreme on that, but it really is. It means it's not a qualified mortgage. So QM stands for qualified mortgage. And it's interesting to see the DSCR loans and all these products come down. Where are they getting sold? Who's buying those? Do people buying them know what they're buying? It's interesting to see. We'll see how that performance rate is. Because think about a loan that's based off of only the performance of the property and the rent. If people can't pay the rent, and that person couldn't qualify to pay the payment on their own, it doesn't take a genius to figure out where that's going. Which is not bad for you, because then that property goes on the market and starts to go into foreclosures, and now we have some liquidity. One of the things that you have to keep in mind is that the reason why it's so hard to find property right now is it's not because I'm out here talking, it's because in 1990 birth rate was so high. Go back and look at the history of birth rate in the US, and you watch a chart and get up to, I wish Jason Wagner was there. Awesome chart for this. Like that, actually. And but if you look at the chart, you'll see that in 2009 it peaked hard. It was after about 5 years. If you follow that trajectory of how many people are in the open market looking for homes, that's going to continue for a decade. Yeah, we've got 10 years ahead of us. That's also why I'm looking at those conversations about where interest rates may go, because supply and demand is going to continue to be a problem. It's yes. We're gonna put videos out on Instagram. We're gonna put videos out to tell people, like, when rates drop, what do you think is gonna happen? And we're not wrong, unless people lose their jobs. And then we might be wrong. But we've got a very interesting balance we're balancing out right now, because when we're talking about investing in properties, so let's focus on rent. It's becoming unaffordable for people to rent homes, right? For us as investors, that's great. When we're like, oh, we can raise the rents. Tenants moved on. I had just had someone move out at the end of the property for 6 years, one of my other places, and I was couldn't believe it. I put some money into it to refresh it because I didn't when I bought it. It was like ready to go when I bought it because it wasn't great, but it was fine. And so I just put some money in it. And I was getting $12.50, and I just went in for 19. Like, wow! And they were don't wow. And when you look at that, it's like, well, but a dollar can only go so far. People only have so many of them right now. This is data, right? This isn't Debbie Downer, but statistically, there is the highest level of credit card debt that we've ever seen. Now, you could also keep in mind that a dollar is not a dollar anymore because of inflation. So of course it's higher because it's worth it. Could say that savings, people are living off their savings because deposits are down. Right now, it was a few months ago that it was 27% down year over year of the amount of deposits going into banks, which is why banks are tightening up on what they're lending because they have the balance. How much they bring in affects how much they can lend. But you could also say that that's not taking into account how many people are putting their money in the money market, or crypto, or these other assets, right? So I personally am watching that closely to see how that correlates, because at some point, if the money's not in money markets, crypto, and other places, and savings are getting drained, and then people are working 2 jobs to try to pay their bills, and now as an investor, I can start to have a bigger concern even than a pandemic, where people are not going to pay their rent, right? Now I'm not going to charge someone $200. You're going back to trying to get $1,200. So you want to think of that in that plan too, as you're stacking your properties. With your installation, we were talking about it earlier. When the pandemic hit that, I paused. I closed on my last multi-unit in 2020, beginning of it, January of 2020, and then I paused because I don't know if I'm gonna, if all of a sudden I'm gonna be in a position where I'm going to pay rent. The government tells them I'm going to have to pay rent anymore. They all decided not to. So I only have one tenant who had any issues with paying rent. They're on a payment plan right now. They literally got another job to create a payment plan to pay it down. And it's been.
Do you think the new program will have a self-sufficiency test?
No. So that's one thing that I can say with full confidence, and I could, I guess, be wrong. I don't know.
Okay.
there's never been a self-sufficiency test with conventional financing test for FHA. I will tell you this though, neat little trick, for self-sufficiency, if you are using FHA, I'm just looking at you when I say points, it's something I really want to do. We've been using that for self-sufficiency, buying the interest rate down, not a temporary buy down, a temporary rate buy down is still qualified off the full interest rate. But if you buy some of the interest rate down, we've been able to pass self-sufficiency, right? And in some cases, we were able to actually get the credit from the seller. So it gives back 4%. We used it actually the full 6%. We used a big portion of that to buy it down. We actually used in one that I just structured with Breach, actually. We structured it to where we bought the interest rate down to pass self-sufficiency, and then we used the remainder of the credit to buy out the upfront mortgage insurance period. So it's pretty, and that client's going to do really, really well because they got a really low interest rate. FHA rates have gone up. They don't have that upfront mortgage insurance premium, so they didn't lose that equity upfront. It's pretty cool.
So can you elaborate on this process, like with numbers a little bit about the buying down, how it works?
Well, so basically you pay an upfront cost to get a lower interest rate, right? So let's say that any given day,
Lower interest rate forever?
Yeah, permanent, right?
Okay.
So let's say interest rates are 8%. And if you were to pay 4% upfront, this is 4% of your loan amount, not the purchase price.
Okay.
Which works well because seller concessions are based off the purchase price. And so 4% credit from the seller is higher than 4% buy down because you're borrowing less than the purchase price. But basically you pay an upfront cost, and that will allow for a permanent interest rate. Basically, when you close, your note will have the lower interest rate. You're paying the margin to the bank for the cost of the money. You're just giving it to us up front in a way. So some people will be like, hey, you're just paying it in advance. Why would I want to give you my money in advance? Well, because at some point it could actually become beneficial. You can't go back and you can't take it back. You can't close and then take it back. You have to do it up front. So you're taking a risk, you're taking a bet. You're betting interest rates will not go down. Not a bad bet when you think about it, 6.5% or 8%. Now, I will tell you, because I like to just, again, always looking at both sides. I mean, it's 5.875 in February. The interest rates were lower than 6.5%. So things could move quickly, but I think it's unlikely. I think that if interest rates can start to come down, I could be completely wrong on this. I'm wrong all the time, so I don't know. But if it seems like it's going to take a pretty big delta to get to where someone would refinance below 6.5. Anyway, you're not just saying rates are going to be 6.5. You're saying that you can be lower than that and refinance that. And even if they went to 5.875, would you really consider refinancing at that point? You might. I might convince you. But,
And the buy down,
data.
Yeah.
how many points the buy down is? 2?
It's anything. It could be, yeah. So a point, when you hear someone say it's a point just stands for 1%. Right, but technically a buy down could be 0.568, it could be 1.1, it could be whatever. And what you're looking at is banks set their interest rates. You get like you just have interest rates, right, going from 5.875 up to 10%. They're not really that fast, but it's a scale, right? It moves in 8 increments, sometimes a little bit differently. And on that, you have the par price. That's the rate you can get. Right? So, okay, this is 8% is there. Now below 8%, it's a cost. The margin there, it costs the bank to like pay for it. So if you're buying the rate, you're paying the discount to get an account. I mean, is everyone familiar with the difference between what a discount point is and an origination point? We've all bought a lot of properties. I'm not surprised to hear that one. Don't feel bad. Most people don't know the difference. I'm actually some of my YouTube videos a big thing.
Yeah.
An origination charge goes directly to the lender. It actually means that the interest rate that you're getting has nothing to do with that origination charge, right? A discount point can only be charged, rest of the states on the closing disclosure. Only if you're buying down your interest rate, it has to be listed as a discount. Right? It's actually paying that spread on that interest rate. You got to be careful with that. There's some lenders right now that charge origination fees that you think you're buying down the interest rate and they're not. They're very well associated with spaceships.
Sam, you also mentioned that upfront mortgage insurance. What is that like upfront mortgage insurance that you're offering?
Upfront mortgage insurance comes into play with FHA financing. So FHA financing has mortgage insurance, right? And you're familiar with PMI on conventional. PMI stand is the acronym for private mortgage insurance. It's issued by a private company, right? So they insure 20%, the difference between your down payment and that 20%. Because the bar has been set for banks that recover to the cost of recovery from a foreclosure is 20%. So if someone puts 10% down, the PMI is insuring the other 10%. So that the bank doesn't lose when they foreclose on the property and sell it. Government loans FHAs are loans that are insured by the government, not a private. So it's you never since I have a stage here, I can share all this without you if you're captive audience. But I mean, you never want to confuse people, but at the same time, it's on FHA. It's not PMI. It's called MIP. It's Mortgage Insurance Company because it's the government's issued policy. You have a monthly amount that you pay, which they did lower recently. It's come down quite a bit. It's great. For 22 years, I've watched that go up and down. But you also have an upfront mortgage insurance. And the upfront mortgage insurance premium is 1.75% of your loan amount. So it's almost 2% of the equity in your home. And it's financed, so most people don't complain. They're like, okay, great, you're going to finance that. I don't have to pay for it now. I'll worry about it. But when you sell, you're technically out that 2%. Yeah. It's not necessarily a bad thing. It's to fund FHA loans, which this tremendous right now actually don't need it. So it's really interesting. And you mentioned VA earlier, right? So FHA insures, VA guarantees. So there are two big differences. It's not insurance because there is no monthly insurance on a VA loan. And also with VA loans, you can take multiple out. You don't have to wait until you take one down. You have a set entitlement that you can use with VA financing, and you just have to recalculate that entitlement so that's not your. Which is great. It's my favorite loan product that exists actually. So yeah, so upfront mortgage insurance is a premium that you pay up. It just has no impact on your monthly amount either. You still pay that monthly mortgage insurance as well. In most conversations when I'm talking with clients about conventional versus FHA, I just say mortgage insurance. I don't say it's kind of a jerk thing to do. Okay? So it's like PMI, it's not PMI, so it might be what? And it's talking about it. And they don't really care.
How do they
More
compare the cost ones?
As far as which
Comparing PMI to MIP.
so MIP is set, right? It's a factor, it's a set 0.55 factor. If it goes actually a little down, if you put 5% versus 3.5% down. And this is what I was talking about earlier. I'll go back to what I was going to talk about earlier, I guess sidetracked. So PMI is based off of how much is insured, your credit score is another big factor. If there's two borrowers, it's cheaper actually, or the people on the hook, I guess, right? So with strong credit, then PMI is cheaper. Credit's not great, and right now that means a 720, then MIP is probably cheaper. But it still doesn't mean FHA is a better scenario because FHA still has that upfront mortgage insurance premium as well.
Is it fair to say that over the life of the loan that they're somewhat equal, or is that not a fair statement?
It's not a fair statement because conventional, which is PMI, can be eliminated when you have 20% equity. Technically, it will be removed automatically once you have 22%. Once you get to 78% of your loan versus the value of the home, the PMI can be removed. FHA is for the life of the loan. Unless if you put 10% down, then it'll come off after 11 years. Yeah, after 11 years it'll come off. So it's not really a fair comparison because chances are you're going to get rid of PMI before you get rid of MIP. But traditionally what we'll look at is clients will use FHA loans to buy using the lower down payment, and then we'll refinance into a conventional loan once they have value. But I've been doing that for some clients recently. We stopped because the rates are so high, it actually doesn't make sense anymore. All right, it doesn't, because I actually have pretty big cachet of pre-approvals of people who come to me for financing that haven't. Maybe you're surprised they can't find a place. So they've been around for a long time and they're just excited over the conventional option, right? Because they were going to refinance. We haven't done it yet. They were going to refinance an FHA loan into a conventional loan, so they can use that FHA loan again and put less down. But now they don't have to do that. They shouldn't have to do that, which would be great. They can use now, they can use 5% down and use conventional financing.
And the difference there is you don't have to do any sort of finance when you're using conventional financing. Once you hit that 22%, right, it just drops off. Versus
You have to refinance it anyway. but-
That's a misconception.
Oh, really?
Because I've been in the same property. Well, first off, let me ask, because I just may not be meeting the rules. What are the values based on? What is the 80-20 based on? Is it based on your original mortgage amount and what you paid for the property? Is it based on actual value? What are the parameters for
So
what
it
makes
depends
it?
on your loan servicer and who's holding the servicing to it. In the first 5 years, they might hold you to on a multi-unit, right? They might hold you to where you need to have 35% equity or over the private.
Well, I was speaking on single family,
A single family home? Yeah. Well, you should be able to have your PMI removed, you can.
based on what are the parameters?
The current market value.
Okay, and then in order for them to drop it automatically, they've got to have an appraisal for current market value.
No, for them to drop it automatically, it means that your amortization schedule, the balance on your loan is at 78% of your original purchase price.
Okay,
In order for you to cancel the PMI, you'll either have to have an appraisal done or they'll run an automated evaluation method to determine if you have enough equity there. It's going to be based off of a third party determination of the value, and you have to have the equity there.
so I've got 5 mortgages with Chase and never been able to get PMI removed on a single property. Properties that I've owned for 20, 30 years.
Conventional finance.
They want me to pay $400 for an appraisal.
Why didn't you pay $400 for the appraisal?
Not gonna do it, just out of principle.
How do you spend?
You should have just dropped it.
Yeah, but if you spend over $400 in PMI,
Oh, I've spent a lot. A lot. I'm stubborn.
Yeah.
I do
don't cut off your nose to spite your face.
But I do some things out of principle. And
I
that's
get it. No, that's honorable. I think it's great. You know what? I like that. That's what works for you.
I've got 30 accounts with Chase, different,
Wow.
through different businesses. I love to support Chase. I'm giving them
There.
extra.
They love it. JP Diamond is actually probably going to come by your dinner.
Following that.
Chasers, unfortunately, Chasers not. I'll say they're not good at lending. They're great. I bank with them. I'm a private client. They're good with managing my accounts. They have one mortgage that was with them back. I got into it. Actually, I had to modify it back when we could do. We were listening to park loans and you could refi plus your terms we use. All right, so there was a time where you could refinance loans without appraisal and development costs, and it's great. You get a much lower interest rate. It was wonderful, but you had to go through the original servicer, so I had to go through Chase for it. And literally was teaching them how to do it. It was insane. It's like, wow. I couldn't imagine someone who doesn't, because I actually know the industry. But you think who should? You got to Karen out on this a little bit. You got to talk to the man.
Karen out.
Nice.
Our manager.
Wow.
Talk to the manager's manager.
I couldn't, because I'm with you. I'm a principal like that. Yeah, totally. I really do. Yeah, I think it is. But I couldn't sleep at night. I wouldn't tell myself because I would know. I'd be like, the problem is if they require a third party appraisal to remove your PMI, can't argue their guidelines. That's their right to determine that, and I guarantee you it's somewhere in the stack of 740 pages that you sign. So you got to go through and you just have to look at it and will they accept a third party agreement? You pay someone else yourself. But I would.
And I believe that if you refi, even though it's with them, and they refi you just to lower your payment, lower your rate, then that resets everything. But I don't know what it resets to.
Depends. So that's one of the, I think I'm glad you brought that up because a lot of people don't realize this. Well, so when you refinance a loan, you don't have to refinance for 30 years or 15 years or 20 years. You can refinance, it can round up to the nearest year. So if you're 1 year into your loan, let's just say that, you're calling me, you're super pissed because you paid 4 points, the rates dropped, and it's only been a year. But it won't be that hard to pull the swallow if you're going to lower your payment, make you super happy. But, we could put you into a 29-year loan. You don't have to step back.
Okay.
But if you do elect to step back on your payment period, just remember that you're starting with your loan amount currently, not your original loan amount. So you are paying interest by spreading it out over 30 years, but you're at the same time you're paying it off with a lower amount that you don't.
But if they didn't do an appraisal on the property, you refinance. You've been with them, I'm 37, you've been with them for 30 years, own several properties with them. They, quote, did the appraisal in the house.
Yeah, they do it's an automated evaluation method. But we use them now openly on purchase transactions and everything. So Fannie Mae and Freddie Mac has developed algorithms to determine their property value based on the data that's there, along with your personal data to determine if an appraisal is necessary. When you buy a home, an appraisal is to determine if that property is worth the collateral for the bank. So you pay for an appraisal when you buy a home, but it's for us. It's to tell us that we're safe lending the money out. So now there's been methods to determine that may not be required. But Chase has their own evaluation method that they're going to run. It's going to say, okay, yeah, the property has the equity.
If you don't ask enough questions like, okay, what did you reappraise the property? You still don't know when that.
They'll probably say we didn't. They'll say we didn't reappraise it. We just determined that you have a sufficient equity position. So we're comfortable. And Chase also can modify the loan. They don't even have to refinance it. They can just modify it. Change it.
So in that instance, you're thinking it's still based on the original value,
Right.
which it isn't necessarily. And I'm not going to say by the purest letter of that 700-page document,
Right.
the big problem is that getting to the person who can say yes, that you qualify in here, we're going to just do it. That's the big problem. Because you can speak to 15 different people, the left hand doesn't know what the right hand is.
Because at some point I'd be like, wow, if I just paid for the appraisal, I could have made more money doing other things than the tax. That's what I would do. I would do up for you.
So,
You probably have low interest rates on us, so you can't refinance out of it.
well, they're always big.
Well, there you go.
Same, sir, almost paid off and still have PMI.
Yeah.
How does that work?
Copy that I paid $130,000 for, and I owe $30,000.
Oh,
Jeez.
gosh.
Wow.
Well, traditionally, you should be able to have a PMI removed at any point in time. Depending on if it's Fannie or Freddie, and I don't want to give a lot of information on which one. You could technically get locked in for 2 years on PMI. So
Unless you are related to Jim Biggs.
yeah,
No, I think
if you go the first year, so the standard procedure is that within the first year of buying a property, if you pay the balance down and you have 20% equity based, not 22, if there's 20% equity within the first year based off the original purchase price, not the appraised value, the PMI will be removed. You can demand to have it removed. Going into year 2, you could pay it off 50% of your loan off, and they have the right to keep it. I have clients that would successfully remove it. Same with an escrow account. If you close on a property with an escrow account, technically they can force you to keep it out for 2 years. I changed that guideline too, because I have so many clients who would get paid. But people don't realize this. When you don't escrow your taxes and insurance, if you have that right, in most cases you're paying for that. Lenders don't talk about it, like you're either getting a higher interest rate or you're paying a fee for it because they charge for it. It's a cost. No one's doing anything for free. And it's funny because people don't realize it. Well, a big trick that I would do is I would tell someone like, look, keep the escrows on, you're going to close, and then before you make the first payment, you're going to call and you're going to tell them to move the escrow. They can't stop you. And they couldn't stop you. And then one day they couldn't. And I don't know if it was a person, but the lady was. They got pumped a lot of loans through and doing that. So banks make money off of lending your money, right? I did a video recently that contradicts what everyone thinks about paying down. We're talking about paying your loan off for a year, paying it off for 2 years. I would do it. I would pay by the I would give $1 above what I have to on my set amortization schedule because it's not compound interest. It does not, regardless of what you see on TikTok and people writing stuff down, it does not change how much interest you pay monthly. You pay that same amount until your loan is paid off. You take your loan out, you have principal, you have your interest. Set schedule that will pay that loan off until you're down to zero. When you put additional money towards your balance, it comes up from the bottom. you pay the same amount of principal and interest until they meet. So yeah, you get paid this interest, but you paid all that interest upfront. So instead, take your money, put it, well, we'll put it in US Treasuries. They're paying over 5% right now.
Yeah.
Put your money into high yield accounts. And let's just say for some reason 18 years does pass and rates all the way down, and you've earned all that money. Well, you want your loan paid off in 15 years? Keep the money yourself, make the interest on it, don't let the bank lend the money out. You make the money on it. Now technically they're letting it out and get paid, just get paid for them to let it out. But in 15 years, pay your loan off, you have a hell of a lot more money in that account than that amount of equipment. Right? It's like people are like, oh, I'm gonna pay that for payment, I'm gonna pay this off quicker. It's a bad idea. And some people are like, it's just how I am, it's just what I do. It's great, that works for you, then do it. But if you agree that this is a way you might be able to benefit.
Is that a hard and fast rule, Sam, or can you negotiate a high-monthly payment where that is coming off of the
It's hard and fast, it's standard amortization schedule. So it is standard. So a lot of, and in defense of some of the people that do videos on different platforms that you see about that, they're usually Canadian, or you're dealing with European system, they're dealing with a different system where it actually is not set up that it is compound interest. Different. So it's a little bit, they're not trying to collude the US population. It's just unfortunately the US population doesn't understand the difference. Why would they? Why should they?
Any questions, guys? I had just one quick question real quick. Has anyone here lately had an escrow adjustment because their property taxes went up?
Yeah.
So we had an escrow adjustment. Our mortgage payment went up because of that, because the escrow account required more. But then for this year, we actually qualified for, you know, they were able to appeal and come to a lower assessed value. But with that being said, are there ever times where that escrow adjustment that went up, does that ever go back down?
Yep. So an escrow account is federally regulated. This is great. This didn't happen when I first had my first property, that condo I bought back in the day in the house over here. I hated escrowing my taxes and insurance because they weren't regulated and managed well. So your loan can get sold to someone and they can tell you owe them money because they need an additional cushion, 3 months, 6 months, whatever they want. Federally regulated now, 2 months at any given time, and they have to run an annual analysis on your escrow account to determine your taxes, and they can never keep more than 2 months worth of surplus. Okay, so you're gonna get that money back. Now, when your taxes go up, right, what happens is the bank pays it. You know why the bank does that?
So they can get paid first
Right.
on top of that?
So yes, you're not wrong. A tax lien supersedes a mortgage lien. The properties foreclosed on and there are outstanding taxes, taxes get paid first. Right? Banks don't want that. That was originally a big driver on an escrow account. Like they do want to use your money and lend it out, but they also want to make sure your taxes are paid. Because that was a problem. Because it's a time when open book on. So, you know, going through it and looking at that, your taxes go up. When your taxes increase, the bank will pay that for you. And they're gonna say, okay, we paid 12, simple math, a simple guy. $1,200, your taxes went up. So your mortgage payment just went up $200. When it went up $200 instead of $1,200, that's like $100 a month. Why do you want $200 from me? This is bullshit. We might be really on our phone. You're in this business thinking I'm the man. Who you're talking to? And you know, I was like, no, it's well, genius. It's because we have to make sure there's enough in the escrow account. Your taxes did go up $100 a month, and we want our $1,200 back. So now you're in a position where $200 a month is being paid out. After 12 months, your payment will go down $100, and will maintain that higher level to pay the tax bill. The tax bill goes down, now you're going to get a refund check, and your payment's going to go down. If recently, when the tax bills came out, you're with his buddy Chase, was a huge error, and they basically more than doubled the tax take. So people were, I got just berated with phone calls from people like, my mortgage payment just went up from $3,000 to $7,200.
Oh, wow.
That was a real number. I was like,
Jesus.
and you know, I was like, no, Like it did, send me your statement, like it did not, if it did, there's a mistake. Right, and it was the problem. The benefit that was really cool is that they made this mistake and all my clients this happened to, like, the same thing. They went to a Chase branch, unfortunately they're in a position, they went in, they paid the shortage, they canceled the rest of it. They're technically within the 2 years the Chase wants it. I said, listen, still cancel. I said, you're hurting more than you know right now, but they really need the deposits. Like just still cancel. But yeah, so they have a big problem. But when your taxes go up, the payment goes up to pay the new increased taxes, as well as a shortage over a 12-month period. Fun fact that I just learned, if you are having a hard time and the payment's gone up and that 12-month spread is too much, ask them to extend it. You can actually get it extended for up to 60 months, 5 years. Never going to tell you that, but it's true. It's a majority of all the loan services. So it's something I just learned about. There was a mortgage people get together and they talk, like the people in the boss and their boss's boss, they talk, and it's something that they're recently talking about was like the services. And some people are going to need that because property taxes will keep going up, so the values keep going up, and they need that help. So that's a good thing.
Yeah, I mean ours went up, 30% last year. Yeah. And our loan got sold from, I think it was Wells Fargo to Mr. Cooper.
Mr. Cooper.
Yeah.
Wow.
Me too.
It got sold, and we received the letter in the mail, and our escrow adjustment came in, and our mortgage payment went up $1,000 a month. And I'm like, well, shit, there goes our cash flow, But you're saying that, like, this year we qualified for, we appealed it again this year, and the assessed value went down. So, there's a chance for it to potentially go down at some point again.
Yeah, they want to make $1,000 a month, and be willing to pay their taxes to go on $12,000 a year. Yeah, unless it was senior exemption or free.
No, it went out.
They might have more money than that. You really want to sit down with someone and make them do you can go into the branch and ask them to do the escrow analysis on the spot.
Okay.
You can't deny it.
That's if the servicer has it.
Yeah, good luck finding
Right.
Mr. Cooper, right? I know.
Well, but it's another bank.
Yeah.
They told you, Mr. Cooper, you can walk into.
Yeah.
It was genius marketing, it really was. Everyone knows Mr. Cooper. Everyone's like, Mr. Cooper, that's the stupidest name I've ever heard. Nation Star apparently wasn't performing. They changed their name to Mr. Cooper, and all of a sudden everyone knows who they are.
So you mentioned like the industry mortgage meetings and the executive, all that talking about in the industry. So obviously these are the proposals now, the 5%, 2 to 4 to help people, affordability, buying the rates down. Are there any proposal out there where the mortgages or people are proposing to Fannie Mae and others to like 40-year mortgages or anything like that? Is that being brought up? Like, what's your thoughts on what other programs that might come up to relieve the kind of monthly payment? People buy on payment; they don't buy on a price.
Did you know China had a 100-year mortgage?
I'm not surprised.
It was very lucky. We buy cars, we buy homes. I said this actually I said the same thing. But we buy homes like people buy a Toyota Camaros. Like, in their country, people they don't buy homes. Their families and generations buy homes. It's not affordable. Like there are other economic models that we can see that are going through similar things that we're experiencing now that have led to these situations. Right? Like the idea of our right to own a home is not exactly is solid, I think. And that was what I was talking about the finance. The reason I am talking about the finance because from 75, when that 18-year period, there were 3 recessions. Recessions do not mean interest rates come down, regardless of what clever video you see. It doesn't. If you go look, there were 3 recessions, and the biggest driving factor on interest rates was inflation. Have you heard of inflation? Anyone heard of inflation lately? No? Yeah. Inflation, oil prices, Iran oil prices, right? You think of any reason why we might have problems with oil coming up already? I mean, there's the real driving factors that could Right. Appreciate it. Thank you all.
Yeah, you Dr. Sam. And before we start our networking, just want to do a couple housekeeping items. The first one is we have our holiday party that we wanted to announce. We have that in the books for December 14th. For those of you guys who are interested, do we have an event on Eventbrite or not? quite
There's
yet?
an event on Eventbrite, but if they do the sign-in sheet, the link will be there once they submit.
Perfect. So for everyone here, make sure you scan the QR code, sign in, put your information on there, and at the bottom you have more details regarding the holiday party we have on December 14th. So we hope to see you all there. With that being said, let's go ahead and head on over to that corner there. We'll take a picture with Sam, and then we'll go ahead and get our networking here started. Thanks again, Sam.